All right. It's that time of the quarter where we're coming up on banks earnings. The earnings season's coming, which means one thing. My man Charlie Peabody, Mr. Bank himself, is here to let us know if banks are topping out or if this is just the beginning of going to Valhalla. Charlie, welcome back. We're always excited to have you on.
Hi, Charlie.
It's a pleasure to be with you, Benny and the squirrel.
It's always fun. You know, I told the squirrel I had a little good faith on Sunday. I was in Malibu for the holiday, and a big squirrel just came up to I was at Gladstone's having fish and chips, which is a very squirrel-like, meal, and just came up there like. So anyway, all right, let's get it going. Let's see. Here we go. We're gonna go and we're gonna start. Let's just start, before we get into thesis, a review. Now, Charlie, we talked a week ago, and I told you I put on the first risk reversal since getting ran over with the SMH risk reversal in April, on the KRE, 78.72 for August. Had a good day today. Well, walk us through what happened with banks today.
Well, banks got smoked today, but that's after having a phenomenal second quarter. So a little give back is not unexpected. To me, the interesting trade is going to be what they do coming out of earnings season, and that starts in earnest on next Tuesday, July 14th, which is going to be a hellish day because you have literally 5 of the major banks reporting that day. So there's not going to be a lot of fundamental analysis done that day. It's going to be reaction to headlines and what management say. But yeah, I mean, banks have traded up to the high end of their historical range. They typically trade at 50 to 60% of the market multiple. They're trading around 60% at least before today. I think they're a sell here on a relative basis at the very least. And I say that because I think this is going to be the peak momentum, year-over-year momentum in a lot of the fundamental metrics.
What did we learn, Charlie, from the Jefferies earnings last week? To look, well, what can we read into Morgan Stanley, Goldman Sachs out of the Jefferies numbers? Because that was a small miss right on the bottom.
Yeah, so it's more of what we saw in the first quarter. In other words, capital markets are extremely strong. And the question is this the peak year in terms of capital markets revenues? And that's my thesis, is that this is the peak year. Now, a year doesn't stop one quarter, it continues. But I think capital markets revenues are going to be down next year from this year. And that's controversial because everybody has capital markets growing ad infinitum. But so what we learned from Jefferies, which are the metrics I use to determine whether we're in a peak year. The first is, if you look at trading results, fixed income is no longer driving the bus. It's equity trading. Obviously, trading feeds off of primary issuance. So if you have a lot of IPO issuance, it generates a lot of secondary trading. So if you look at year-over-year growth, and I don't have the Jefferies numbers in front of me, but let's say for the banks, it's going to be mid to high single digits on fixed income. It's going to be mid-teens to high teens on equity on the trading front. So that's the first thing you look, is that transition from fixed income to equities as the driver of the bus. The second thing you look for is trading driving the bus, or is it investment banking that's driving the bus? And you're going to see, again, that it's investment banking that's driving the bus in terms of much more aggressive revenue growth. And then you look within investment banking and you look to M&A as the driver of the bus. And that typically, again, occurs at the peak of a cycle. M&A is the driver of investment banking revenues. And you'll see that this quarter. You saw that in Jefferies' quarter. Fixed income debt underwriting, tends to slow, and equity IPO issuance, is very aggressive. And then within M&A, you look at, what is the volume of deal announcements and completions. And typically, M&A peaks at the cycle around 4 to 5% of global market capitalization, or 5 to 6% of global GDP. So we say,
is that the amount of trailing 12-month deals, or like what do you mean by
announced deals?
Announced. Okay.
Yeah.
Thank you.
So we had, I think, let me just look at my notes for a second. Yeah, we had announced M&A in the first half is 3.2 trillion, so annualizing to over 6 trillion, and completed M&A in the first half is 2.7 trillion. So again, annualizing, to just under 6 trillion. So if your global market cap is what, 130 trillion, and you're, let's say 4 to 5% of that, that puts you in the range of peaking around 5 or 6 trillion. And if your global GDP is 120 trillion, give or take, and you're 5 to 6% of that, again, you're somewhere around 6 trillion. So we're on pace for where typically M&A peaks out relative to global GDP and global market cap. And then the last metric is the mega deals. We're going I think the last mega deals are M&A deals in excess of $10 billion in value. And
so we're going to talk about Paramount, basically. I was just going to ask you that. So let's talk
those
about it.
Types of deals, yes. So there's always a marquee deal, a mega deal that sort of marks the top. I think it's going to be the Paramount deal, but and that doesn't mean they don't get done. They get done, but the after effect is just horrible.
It's AOL Time Warner all over again. It's always the media guys.
Exactly.
It's actually more than that, though. If you think about it, like, as Squirrel know, as both of you guys know, because you talk to me a lot. When we think about Oracle as the red-headed stepchild of the hyperscalers, right? Like, it's there, but it's like, you ain't really, like one of those tests where like, which one's not the same? It's like, very clearly those guys are not in the same boat as those other four. I mean, that deal is basically collateralized by his equity of Oracle, right? And so what happens if, and look, there are parts of Oracle's data business that are going to be valuable in this new world. So like they do have a bit, but they're adding a lot of capital, and like, we'll see, is there a double whammy potential there? Or is there even a chance this doesn't get done? I know that they tried to bring it to the Supreme Court, or somebody, I don't know exactly, but they were trying to challenge this quite hard, weren't they?
Yeah, I mean, I think it's going to get done, Ben. But if it doesn't, then Oracle is on the hook, because let's say the Saudi money or there's 3 different Middle Eastern pockets for the equity. And let's say all of a sudden they decide the war has strained their purses and they're not going to put it up. Then you're put Oracle on the hook, and that is going to be very difficult, I think, for Oracle to, without setting off some sort of chain reaction, given how big they are in the AI data center funding mechanism. But I'm going to assume it gets done. It's just the after effect and the returns are so poor that it starts to hurt the confidence of the buy side. And I think that's where you sit with something like SpaceX. You get too many of these deals that don't have good. Now SpaceX is still above its offering IPO price, but it's around where I think it's around where it's opened day one. 150.
Yeah, it's about 148. It's about where it opened.
Yeah. And so if you start getting poor aftermarket, that's going to start to wane on the confidence of the buy side to take on more of these deals. But the bottom line is, going back to your question, Rupert, is all the metrics that you would look for to say this is the peak of the cycle were there in the Jefferies numbers, and they're going to be there in the major investment banks next week.
Yeah. So let's look at this. Let's look at this real quick. So this is the black is the KBX bank, or BKX, sorry, KBW Bank Index. Then you have the shadow banks in the PE shops and the BDCs, and then the blue one is just credit, just to throw that in there as a market thing. I put the jaws in there. Those are big jaws, Charlie. Like, how long can this last?
Let me talk about the private credit guys, because for me, that's a story I've been on since the spring of last year. As you may know, Ben, I've been sort of alluding to them as, this cycle's 1907 credit, epicenter. So in 1907, the panic in 1907, the trust companies were the epicenter of the panic. And I think it's, the epicenter of the credit crisis this time is going to be private credit, private equity. But, from a very high level, the story is simple. You've taken what was a growth industry and therefore had high multiples, and you're turning it into a risk management story. And if you get the risk management right, you get your money back. But if you don't get it right, there's a lot of downside. And so I don't see there's any upside, other than a minor bounce over the summer in these private credit, private equity names. What is interesting is if you look at FRE, fee-related earnings for 27, they're still forecasted to be up, 20% plus. And we actually think fee-related earnings next year are going to be flat to down. So there's a lot of earnings inflation in these names. And part of the reason that we think they could be down is the liquidity issues. And that chart you had up there of the jaws, and Rupert's question about M&A is one of the reasons. If you look at the M&A that's going on right now, which is a way for private equity to monetize, their investments, it's all these mega deals. It's not the small and middle market companies that private equity is invested in. So on one hand, they can't monetize their investments. On the other hand, their fundraising is slowing. And then on another hand, they're getting more and more redemptions. And we think the redemptions, if you look at BREIT as sort of a prelude as to what, the other, what we're going to see in the cycle for private credit and private equity, BREIT had redemptions for 4 or 5 quarters, if I recall correctly. So I don't think the redemptions that we're getting this quarter, are going to be the end of it. So I think the liquidity, it is a slow drain. It's not an overnight panic, as Ben has pointed out, but that liquidity, drain or pressure on these, private credit, private equity names, I think continues into early next year.
Yeah, and look, it's funny because last year, the pension fund was trying to move their money, and we looked at it and was like, it's like 80% private credit. It was insane. It was like the most insane thing. And then we looked into how do we get rid of some of the stuff? And it was like 20-25% haircuts, which is just too much. These are still loans, and you're gonna have to go deep down. I'm not getting in that game, but retail, pension. It's just, if you only get 5% out, it's just a rush for the door, like a bunch of lemmings, and it's gonna take a little while. And to be fair, we can all sit here and dump on these guys, but it's ultimately better for the system to have these gates than as Silicon Valley or bank runs. No one wants bank runs, right? Right. At the end of the day, our boy George from Wonderful Life will tell you bank runs are no good.
Yeah. The other thing that's going on under the surface is the insurance regulators have been, they've wisened up, let's call it, as to how these insurance companies are being used as stuffies for, vehicles that allow for capital arbitrage and self-rating of junk bond credits, that are rated as, investment grade. And so they're starting to crack down on that. And we've seen some structures created recently by Apollo, which suggests that the regulators are saying, you got to either move these higher risk CLO, credits out of the insurance company, or you have to change the structure to make it less risky. And they've been, creating things called AMAPs, which literally removes the investor 3 layers from the actual investment. So it creates an opaqueness, which I think is actually working against this industry in terms of valuation. That's why bank stocks trade at 50-60% of the market multiple, because no one knows what's on the balance sheet. Well, you start.
What does AMAP stand for?
I'm going to have to read it because it stands for.
I love a good acronym.
Yeah, it stands for Apollo Multi-Asset Prime Securities.
So who's buying those, and what are they? So they're like a synthetic risk transfer instrument, and so who are they finding a home for those?
They're replacing the CLO. So, for example, in Athene, I think Athene had like 33 billion of CLOs, which, by the way, we call clowns, CLOWNS, collateralized loan obligations worth nothing. AMAPs, it's a complicated vehicle, and so the takeaway that I want you to understand is it layers on an opaqueness that makes it very difficult for the investor to know what they've invested in, because it creates a vehicle that invests in another vehicle that invests in the direct loan. And I gather from what we've heard is it allows you to build NAV and therefore to create more FRE, fee-related earnings. So, sometimes Wall Street gets to be too smart for itself. And I think this is one of the things that's going to hurt them, because, that's what hurt the trust companies back in 1907 was people really didn't believe the NAV of those trust companies because they didn't understand what was in there, and only J. Morgan could value things with his henchmen. But I do have a report here. I don't know if you can see it, that explains what AMAPs are, and I will, make it available to anybody that wants it. It's actually written by my associate Lily Collins.
That's like the most old school / new school. Like, hey, we're on like a podcast, or I got AI slides, and you're like, here's my paper report printed out with color. You guys color printing? I used to do that all the time, and just like the first job I ever had, not I guess second, but like my summer MBA internship was at a place called Nicholas Financial. First report, I just kept printing color, and eventually they're like, dude, you don't have to print this much color. It's expensive. All right, so let's go to this real quick, because we talked about this, Charlie. This is a slide that I put on the Sunday show with Rupert, where I was going through, Deutsche Bank had put these charts out, and then obviously I put them through the Nano Banana to make them look, more fun, because nothing about Deutsche Bank's fun. And and so, do you really think financials are there, or is that insurance, or is that a different part of it? Yeah, like why is it saying that where you're saying this is the peak? And your valuation.
Would this be all financials? So it include insurance?
That's what I'm thinking. That's what I'm thinking. It is. Like, I think that might be the issue. Because like when we talked about this, like I had shorted the same KRE trade, risk reversal, in February when it was at 74, like right around here, it was just full, and then went to 62. And it just kind of feels like the same thing. And by the way, we can talk about it in a second, Charlie, but we're getting a flattener. We're getting, capital markets kind of are not getting better than they have been. Like, OpenAI gets pushed back. There's a little bit of, it can't get better than it is right now. Let's put it that way.
Yeah.
Right. So there's not much incremental growth. And so do you think that this is, a methodology thing? Do you think this is other areas of the financials? Because you don't seem to think that, like, and you have clients, institutional clients, like, sounds like the generalists and everybody's full, and that's what the price charts would tell you.
Yeah, and I think I obviously don't know what's in this particular chart, but I do suspect it incorporates all financials, and I'm guessing insurance are probably underweight. The fintech probably don't have a high weighting. Some of the exchanges probably aren't highly weighted, but when I talk to people, there are a lot of generalists in banks, and that's what obviously I'm talking about when I think they're well owned. And when you have only the specialists in banks, then they're probably market or underweighted. But there are a lot of generalists in this, so I think they're overowned. And there are three sort of broad themes that have the generalists involved. One is deregulation. In other words, this is the one industry that's undergoing significant deregulation, and therefore they deserve to be re-rated higher. I want to come back to that because there was an event today. If I forget to talk about it, either Ben or the Squirrel, let me know. But the second is capital markets have an unbelievable backlog, which they probably do. The backlog is strong, and therefore there's growth from here to Timbuktu. And then the third is that the credit cycle is never going to appear, and so when you get
we have some slides on this. We call you on your note on Sunday said the summit and the descent. Charlie, I've always liked you since I met you, and we became friends a couple years ago, and we started Wall Street Beats, and you're calling for a top, basically, like more or less in your sector, which is, maybe not the most important sector today, but it is one of the top sectors, in the economy for sure, and in the market.
Financials are about 12 or 13% of the S&P 500 in terms of weighting. So it's an important sector, particularly if you marry it up with tech, another 40%. So you got 50% between those two sectors, and if they both roll, and that's an if, but if they both roll, this market's in trouble.
Yeah, healthcare's not going to bail it out. Healthcare, well, maybe energy then.
Energy's not. Energy with its 3.5% weighting, and he's not going to. Healthcare is like, I don't have the chart with me, but our buddy partner David Maris, I've been bothering him about that. Healthcare has been solid, and the Squirrel brought it up on Sunday. Biotech's getting a bid, and a friend of the show, Craig Shapiro, was bitching in our chat that we're all in on WhatsApp. Why are biotechs going up? Rates are going up. They don't seem to care. Money's flowing into healthcare because it's been nothing done there for a long time now.
Yeah, and I am calling for a top in the bank group here. And if I'm wrong, one of the reasons will be that rotational trade where money is coming out of the SMH and into financials, and that can take things to way overvalued.
Right.
I respect that possibility.
Can I ask you a question? Because I was just a very, very young bear, not a squirrel. I was always a grizzly bear. Came out of the womb as a cynical bear. But in 2000, 2001, how are the banks, how did they trade into the .com? That's something I've never, I wrote a trading strategy that caught the move in small cap and mid cap banks. So I know there was an absolute ripper when that small cap value thing happened in 02, 03. But how was that back then? If we're going to use that as some kind of historical analog with, maybe a 0.4 R squared or something.
Yeah. By the way, Ben, we don't call ourselves bears. We call ourselves natural skeptics. So anyway.
I literally have a hat that's a grizzly bear, so I call myself a bear.
I off the top of my head, I can't remember. I know that the banks bottomed early after the sell-off, and they weren't too hurt. I mean, they were hurt, but not impaired the way they were in 07, 08. So
apart from the first sort of .com cycle wasn't credit driven. It wasn't really credit driven.
There was some credit. It wasn't huge.
It was some credit, but it was essentially an equity wipeout, right?
It was a sector. You had kind of the oil shale boom, right? There was a credit component to that, but it was localized and it didn't have systemic issue. It was just movie theaters and fiber guys and everyone in the TMT space all kind of went belly up. But it wasn't this thing that we have now. This is ubiquitous, this is beyond
everywhere.
This is like subprime, but it's not because of the leverage that's chopped on top of it as much as it's just huge size. I mean, we're now double the whole or maybe triple the subprime, the total subprime of 08. Now I understand S&P is much higher and notional of dollars over 17 years, but these are big numbers, 2.2 trillion.
When you're talking about that numerator, when you're saying what are you talking about? Debt associated with AI capex, or what are you talking about?
With the data center infrastructure,
the 2 trillion.
I have the capex monitor, which I told you I was built, and I give it to my paying subs. So I never market anything. That's my first. There you go, being a little cheesy. It's about 2.2 trillion, but then we can also add on because Charlie knows that we had Lax on from Unicus Research last week, and she's very deep in the weeds on the other part of private credit, right? Because we didn't talk about data centers with her. She was kind of more in everything else, the legacy software, the other businesses, all these companies that don't actually make money, and all the huge chunk of it is PIK income. Well, that hasn't gone anywhere, right? The only thing that's maybe improving is what Charlie said, right? Is that real estate's finally clearing, and they're clearing at bad prices.
Right.
I mean, if you follow any of these real estate guys on Twitter, I mean, you can get some buildings for some dirt cheap numbers right now. Like that is a state of 2009 level real estate distress in commercial real estate, not data center.
Yeah,
or
no,
industrial.
you can pick up some nice properties in New York City or San Francisco and probably do pretty well over the next 5 years with that.
Yeah, I'm not a real estate guy, but I think that there's something to do there. Like I think it there, and I get sent some of these private deals, and it's the first time in years that I've been like, oh, this might be interesting. Plus, you could get the re-rating if rates go down, right? Because they all fund with SOFR.
Yeah, but also, my area of interest in the real estate, I had mentioned to Ben, Rupert, that the banks literally for the last 3 quarters have all talked about how they're now starting to reinvest in real estate after spending, a year or 2 or 3, degrossing their exposure there. So they're seeing, projects clear at their written down values, and as Ben said, they're pretty, deeply discounted. But the area that I'm most interested in is the multifamily area. And again, more selective, like West Coast, East Coast, less in the South. And that's because, if you look at what's being built and absorption rates by 27, 28, you're going to have more demand than you are going to have units. And I think rents, start growing a little more aggressively. Absorption, occupancy rates, move back to the high 90s in some of these areas. So, an
those stocks have traded well. Those stocks have traded well recently, right? I mean,
they have actually. The whole real estate, sector has traded okay. Now I'm not buying, office REITs, but I did buy.
There's not even much cap left there. Like there's AI startups that started like a month ago that have bigger cap than them. The whole sector.
Yeah. But the other, sort of going back to that .com bust and the parallel today is I've talked with you guys about the wealth effect of real estate and stocks. And if you look at real estate, it starting in the 3rd quarter of last year, it stopped being a wealth creator for the upper income sector of the consumer. Stocks continue to be an incredible wealth creator for the upper income segment of the consumer. So if we have any kind of market correction that stays down, doesn't do a V-shaped type of reversal, we're going to lose that upper income consumer in terms of their spend. And they and the AI CapEx are the total spend for this economy.
I totally agree.
And the government's still running 6 to 7% deficit, right? Like if you look back when I got sucked into the Trump train of we're going to cut deficits. The squirrel told me they're never going to do that. He's bullshitting you. Squirrel was right. I got tricked because I just wanted to believe in it. But like they're still at 6, so they're not adding, right? Like on a delta basis, it's not adding like an impulse of growth. But it's not subtracting either. Like if you remember in 22, one of the big drivers of 22 was we went from 3 trillion deficit down to 1.2. I mean, that's a huge headwind. And, I don't know what episode it was, Rupert, but we talked about the Kalecki profit equation and deficit saving, dissaving, whether it's private sector or it's public sector is a huge driver, and then CapEx being the third. Right now, CapEx is driving the train. I mean, it's just, that's all that really matters, which is why we've become, we talk about it a lot now. I mean, and Rupert, do you ever think we talk about this?
It's a dirty little secret. It's part of the thesis behind my sort of rest of the world equity trade, because I think on a relative basis, there's going to be more fiscal activity outside of the US going forward, certainly on a rate of change basis, which is what makes me much more bullish overseas stocks relative to US stocks right now.
Right, and just as one aside, I brought this up with Charlie when we were talking on the phone earlier, Rupert. Are we thinking gold? Are we thinking it's time to start getting back in the gold game? Like,
the only thing that would hold me back on that is that we look like we're re-accelerating in the Gulf right now, and there are a lot of sovereign owners of the yellow fella that need to sell that stuff when they've got data centers and power stations to rebuild.
Charlie, what do you think?
I think we're within 10% of a bottom, but it could be, you go down another 10% and then you go sideways over the summer. So to me, it's more of a 4th quarter, 2027 trade to buy gold, which is not that far off.
Yeah. Okay. So let's go right back to this, Charlie.
Yeah. Go back to your peak. Yeah.
This triple peak and then I'm going to go into, so walk us through this.
So
Peak.
what I was thinking, when I called for, peak bank stock prices here, is there is a good historical correlation, and it's a coincident correlation between bank stock prices and the year-over-year rate of change in what we call PPNR. PPNR stands for pre-tax, pre-provision net revenues. So, and what that essentially is, total revenues minus operating expenses, where operating expenses does not include any credit costs. That's left out of this equation. So total revenues minus operating costs. And that's going to grow year over year about mid to high teen rate here in the second quarter. I have it up 16% year over year. And I think that that's going to be the peak change in PPNR. And, when I look at the quarterly changes, I have it going, so it was roughly 15% in the first quarter, 16% this quarter. It drops to about, a high single digit rate in the third and fourth quarter, and then goes to a mid single digit rate in the first half of next year. So we decelerate from 16% to 5%, by the second quarter of 27. What that tells you is there's less cushion for absorbing credit deterioration should that emerge, because that's the final piece before you get to pre-tax income is PPNR minus your credit costs. And so if we have a credit cycle on the corporate side, which is my bias, then corporate credit costs are going to go up. I will tell you, if you look at analysts, consensus models, they have corporate credit costs flat, absolutely flat, for this year and next year, in the second half of this year and into next year. So that would be a negative downward revision. And that gets back to, what Jamie Dimon said, a month or so ago when he said this industry is over-earning. You've got loan growth, running at a high single digit rate, which is very aggressive, when you're in a, 2 or 3% GDP economy. You have capital markets that are incredibly robust in terms of the volume of deals. And you got credit costs that are near historical lows. So that's why JP Morgan can generate a 23% ROTCE, is because you've got peak volumes in loans and capital markets and low credit costs. So I do think this industry is over-earning, and I think we're going to see that start to normalize in the second half of this year.
Yeah, and so then here's where it comes out at, and me as the although Charlie, you might be more of a trader than me even. You love those slinging around. We're talking about your expertise now, but I know you might trade MP materials in June of 24 on try and get me in there, and I didn't get in there. Look at this chart, right? The risk reward's no good. Momentum versus valuation. This is all these banks that you put in your report. That just is not good. Slowing growth, high valuations. Has anyone ever liked that combo in history?
No.
And this is a good time for you to jump in, Charlie. Well, you mentioned there was a big regulatory announcement today.
Yeah.
And this is part of the hook that the bulls are relying on. Yeah.
So deregulation is the big theme to get these things re-rated. And my thesis is, that may happen eventually, but the banks have to prove themselves in the next credit downturn as good risk managers before they can get re-rated higher. I think they will, and that to me is the difference between analogies to 1929 or 2008 versus 1907. In 1907, the banks actually were the solution to the problem that the trust companies had. In 29, the banks were the problem. In 2008, the banks were the problem. I think that this cycle, the banks will be the solution to the problem. So that's why I use 1907 as my analogy. But going back to deregulation, today, deregulation is going to somewhat depend on how the midterms turn out. And if the Democrats can regain control of Congress, then I think that deregulation thesis is going to be pushed out even further.
Yeah, that's really a good point.
And secondly, one of the themes around deregulation was going to be freeing up of all this capital. Well, there are a couple of capital rules that are sort of in play right now that have essentially been either frozen or pushed out into 2028. The DFAST CCAR stress test that just, the banks just passed normally would have allowed for a lower, what we call stress capital buffer, and therefore more capital to be redeployed. But the regulators decided to freeze that buffer until October of 27. So you're not going to get any relief from this stress test that just, passed. And then the Basel III and the GSIB rules that are being rewritten are probably going to get passed by the end of this year, but there's a phase-in implementation period that won't start until January of 28. So you're not going to get any capital relief beyond what you already have. In the meantime, if rates rise, you have a negative AOCI, which dilutes your capital capacity. Banks were very aggressive in the first quarter in spending their excess capital on buybacks, largely because they issue a lot of equity for compensation. So they wanted to neutralize that dilution. But the bottom line is, banks are not running with a lot of excess capital today. They may in 2028, but not today. So most of the capital that's going to be used for buybacks has to come from internally, organically generated earnings. And if I'm right about the reduced cushion going forward, they're not going to be able to generate as much capital as they are today. So I think buybacks slow. Anyway, let me get to what you asked, and that is today, Elizabeth Warren, Senator Warren, who is a thorn in the side of the banking industry, sent a letter to Citigroup, Jane Fraser at Citigroup, who has become, Trump's favorite, CEO in the banking industry. And she basically said, I read in the journal, a week or two or three ago, that you're interested in making acquisitions. And so I want to know more about your acquisition plans. And she demanded, that they inform her of various factors, which I'll get to. But she says, basically, if I have anything to say about it, I'm not going to let you do acquisitions. And she cited three reasons for that. One is that the risk that they would pose from acquisition to the stability of the U.S. banking system. The second is the lack of managerial resources, and she gives reasons behind all of these. They're very biased reasons, by the way. I'm not sure I believe a lot of them, but and then the third is that a transaction including Citigroup getting bigger would not benefit the public at the community banking level. So here's a Democrat who may have the power if Congress rolls over in November to start pushing back against regulators and their willingness to let the banks do things more freely. And I think this is a good example of why deregulation is not going to result in a re-rating of the banks just yet.
I think that's 100% right. And I just talk about this for a second is why are we seeing so much paper? The squirrel has been adamant all in the Q2. Hey, let's talk about all the paper coming. He just reliving his glory days of being the paper issuer. But seriously, now we have the SK Hynix doing $29 billion. And so you don't have, as Charlie said on the Wall Street Beat show this morning, you had to have a Korean account, and it was just a mess to try and trade the Kospi. Well, now you can get in there and trade that direct. And let's just say maybe they're worried about that, right? And right now we're in the seasonal low volatility point, implied correlations mid-single digits, and it's just the time to sell paper. It's the time to harvest. And by the way, the S&P and the QQQ, we've been flat for 2 months. And the last couple times we've gone flat for extended period of time, election till February 18 in 2024, 25. And then last year, we're, into the March, the Q1 of the flat markets, they're just getting ready to turn around. That's just what they do. You either go up or you go down. And when you go flat, you either run out of sellers and you go up, or you got a lot of supply and eventually, that negative convexity kicks you in the teeth.
Yeah,
what do you
Ben,
think about that?
I don't think there's any coincidence that we have this huge mega deals. I mean, we're on pace to do over 80 mega deals in the M&A front. Mega deals being over 10 billion in value. Last peak was 21, about 70 mega deals. And I don't think it's any coincidence that we're getting the mega deals now because they think the FTC or the DOJ are going to be much more favorable with Trump controlling Congress. He may still control Congress after November. I don't know. But do you want to take that risk of delaying your deal announcement until after the elections? I don't think
no,
so.
I think that this has been very clearly proven to be a very pro Silicon Valley, Palo Alto administration, right, guys? Like that's pretty much,
Well,
I don't want to say fact, but like what?
They bought it.
Yeah, they bought it for sure. 100% bought it. Yeah,
Absolutely.
So that's where you think like, oh, we're 4 or 5 months out from that event. Every day we go forward, it's going to be a little bit seeping into people's consciousness more and more. They're going to be thinking about it a little bit more and more. And if the Dems win, I don't think they're going to be like, oh, let's jack up the deficit. They're going to be like, we're going to hang you, because that's, that's what they wanted to do. And, if you think about state space, we don't know what's going to happen, but the probability of that regime is increasing. So you have to adjust prices for that, if that makes sense, right? Like, we don't know the end result, but the way we price options is there's this regime and there's this regime, and the rising amount of Dems take over, which I would think, and maybe Squirrel, you can comment on this, not good for asset prices.
Yeah. And, Ben, you're more schooled on this issue than I am. I'm a novice when it comes to options, but I do follow what's going on with Core 1M, and that's a measure of single stock, dispersion versus indices. And that's down to like 4 or 5, and you get below 8, and usually coming out of that, you get some kind of spasm. And I think that goes back to what you were saying. I think we're setting out for some kind of significant spasm in the markets.
Yeah, and basically, if you go back to January, Rupert and I talked about that, where I saw that, it was the last time we were down in the 4 or 5 range on implied, and realized it was just pathetic. And then we got to jump up to like an 8, 9, 10. And I was like, oh, the game's starting. Everyone's like, oh, whatever. Because, if you remember the beginning of the year, small caps were ripping, gold was ripping. It was just like, it was like a damn circus.
You just need to look at a heat map every day, right? The first thing I do, I look at an S&P heat map, and you think of the market cap changes that are going on every day at the top of the S&P, like, hundreds of billions of dollars of market cap, multiples of revenues, many multiples of full year revenues in these large issuers because of this dispersion. It's just simple displacement theory. It's physics. Right, and at some stage that has to completely unwind.
Yeah, and I think it means it's not real. Like, I always go back to the concept of John Galbraith's bezel, and Michael Pettis wrote a great paper in the Carnegie website that he writes for about it in 2021, when we had a bubble by all means back then, and you see those numbers, but that's not real. You can't, I think people think like you can take this stuff out. Like, we'll see. They're starting to try to, right? Here's 20 billion, here's 80 billion.
Yeah, this is interesting. So this is the whole this is the whole top of book liquidity thing that we were talking about in the concept of in the context of SpaceX. Now, the master of all time, Musk himself, the PC Barnum of modern securities industry, is, he genuinely found net new liquidity from around the world. It was $1.5 billion from Aussie retail. It was, another $1 billion from Gina Reinhardt,
he's the
iron ore magnate down here. I mean, and he shook every single tree globally, and didn't have to test that top of book liquidity where, let's see how real that liquidity is once you strip out the high frequency trading and the delta hedging.
Yeah, and liquidity will disappear very quickly if you get extreme volatility. So to sort of wrap up my knowledge of what's going on in banking, and to debate the bulls, there are 3 things I mentioned: deregulation, capital markets growth ad infinitum, and a benign credit cycle. Well, on the deregulation front, Senator Warren just put the market on notice that if they take over Congress, this is what's coming your way. On the capital markets front, if we get the kind of volatility that Ben, you, and Rupert are talking about, it's going to erode the confidence of CEOs to do deals because they just don't know how to price things. So I think that capital markets, sentiment can change very quickly, particularly if we start getting hung loans. And then on the credit front, I published some data that shows, what the loan loss reserve ratios were back on March 31st of 2000, which was just before we had the COVID recession, and where they are today. Every reserve ratio today is significantly below the March 31st ratio. So you don't have as much balance sheet cushion in terms of loan loss reserves, and your earnings cushion is starting to thin. So and banks now are trading at the upper end of their relative multiples. So I just don't like the risk rewards of
yeah, and let's be clear. Everyone can sit here and tell me how rates are going to keep going higher. Like, I mean, then just own gold, because if rates are going higher, it's going to be like a turkey situation, right? And then you just own gold, like, because we're getting close. I mean, what did we say, Charlie, this morning? The 30 years at like 508. 10 years still hanging in there in that 450, 460. But if the 10-year gets back to 5, it's going to start causing some, indigestion. They might need some Tums. But like, people don't like really realize that like things just break down. And so like this idea that rates are going to fall apart, like there's just too much leverage. There's too much leverage. It just doesn't work. Like, we're at the high end of the band, and we've been able to keep it here because we got a CapEx boom. We got $2 trillion of deficit from the government. We got all of a sudden the Europeans are running deficits. The BOJ is running negative 100 basis points real rates. They're just pumping money, and which is why the yen, the beach ball, as I like to call it, is on its way to 200. And I'm just saying, like, every other area to keep it going has been keeping it going. Like, at some point, there's not going to be any other levers to pull, basically. Like, what I hear from you, Charlie, and you've been in, you started your own bank research company for multiple decades. You've been on the street for 4+ decades. You're kind of telling people publicly, like, hey, there's no juice left, or there's no meat on the bone here, right?
None. And, going back to your comment about, government injecting liquidity, the TGA account, which, was over $1 trillion on April 15th, is down to 800 billion now. And and that's a source of deposit, as they inject liquidity in the system, it becomes a source of deposits for the banking system. And if you look at the banking system and talk to the bankers, they're starting to worry a little bit about deposit growth. It slowed in the second quarter. And excess reserves now are around 3 trillion. They don't want excess reserves to drop, much below 2.9 trillion. So, liquidity in the banking system, I wouldn't say is robust. It's not dire either. But there are not a lot of levers that are going to be, pulled here that's going to enhance. And then the last thing I just mentioned is, if you look at discount window borrowing, and I want to caveat this, but if you look at discount window borrowings, they're just under $8 billion, which is not a low number. It's not the kind of numbers you saw during Silicon Valley bank runs. And some of that is very benign borrowing, in the sense that banks are testing the window to make sure that they have a program in place to deal with liquidity if they need it. But if we start getting over, I'm going to say 10 billion, then there's something wrong with the liquidity in the banking system. And so we're not that far off here at a little under 8 billion. And then the final thing I watch is to see if there's, secondary credit borrowings, because that means the primary credit borrowings have been used up, and now you're having to,
Can you unpick that for me, Charlie? What do you mean by secondary credit borrowings?
Well, you're allowed to borrow from the discount window for a short period of time, and I forget whether it's 90 or 180 days, but somewhere in there, that period. And if you have to continue to borrow beyond that, they reclassify it from primary credit to secondary credit. And these are all on the Fed's balance sheet. You can see these numbers every week. We had a little bit of secondary borrowing credit 2, maybe 3 weeks ago, minor. So I don't want to make a big issue of it. But that's what I keep watching, is to see if all of a sudden this primary credit starts showing up as secondary credit, because that tells you somebody's in trouble.
Okay.
Yeah.
And just actually another just coming back, I want to touch on another thing you mentioned. So in Q1, you said the banks did a lot of buybacks. I mean, What sort of number are we talking about at ballpark across the sector?
Oh, they were buying back easily 5 to 6% of their stock.
In Q1 alone?
No, on an annualized basis.
On an annualized basis, okay.
Yeah.
So I'm just trying to, this all plays into the whole supply equation again. I mean, you know, if we're losing hyperscaler buybacks and we're potentially losing, you know, bank buybacks, you know,
they're certainly not going to get any stronger, and it's more likely they start to fade a little bit.
Yeah, I just think, you know, that's another important macro input in terms of the whole paper issue. Sorry to be a bore about the paper supply issue, but that's going to be the theme for the balance of 26 for me.
Yeah. I mean,
that's what people come here for, Rupert. They want to hear you talk about supply. You know, it's like the way I talk about volatility, you talk about supply. You know, it's our thing.
I remember listening to Rupert on one podcast, and he says you have to pay for distribution, and you know, that comes from a guy who was a distributor, if I recall correctly.
And he got paid pretty well to distribute it, I think. I think he last time I checked, Goldman Sachs managing directors get paid okay.
So this capital markets activity, right? The you know, a lot of this new issuance of equity by the big guys is going to take the form of at the money offerings, right? And you get paid peanuts for that. So actually, you know, and you know, it doesn't count for league tables either. It's actually it's not great business for the banks. So you know, this is going to be low margin stuff for most of the balance of the year.
You know, that's going to be interesting because, you know, as you and I have talked about, Rupert, I think the pot for the SpaceX IPO is about 500 million in fees.
It was smaller than that, actually. He cut it much more because I mean, I took a look at the final prospectus, and I think that the Goldman and Morgan earned less than 100 million each.
I was going to say that, you know, initially people were thinking they would earn a couple $100 million, and you're right.
The joint lead lefts, if we're calling it that. So, you know, actually, yeah, it was an okay payday, but they had to buy a ton of grok. They had to, they had to redecorate their lobbies. You know, there was some costs to offset against that number.
Yeah, and you know, and I'm probably high on the street in my estimate for Goldman. I'm at $15, and I think the street's at 14 and change. But it's interesting, you know, the people that have 10 times more visibility on banks than I do, like a Mike Mayo, recently have been cutting their numbers on Goldman.
Yeah.
But you know, it's you know, talking about some individual names, there's going to be some interesting things on next Tuesday. First of all, I just point out Bank of America, which is always reported the second day after JP Morgan and Citi and Wells Fargo, is moved up their report date to the same time as JP Morgan and same hour as typically JP Morgan gives their conference call. So there's something going on between Moynihan and Jamie Dimon, you know, vying for attention. And I do know from talking to Bank of America, they're very frustrated by the fact that their stock has been a laggard this year. And they're producing what they said they would produce, you know, at their investor day last November. So I'm guessing they moved it up because they feel like they've got some good numbers and they want to, you know, show that. So that was an interesting change. The other is, and I'll leave the name out, but there was another big bank that I talked to pre-earnings, and they went out of their way to tell me they were going to build their loan loss reserve this quarter. Now, that's important because typically banks don't make that decision until the last day of the month, so June 30th. And we get cut off, you know, blackout dates starting around the 20th of June. So historically, they've never told you what they're going to do with their reserves. They'll give you some guidance on charge-offs, and then you have to make your own assumptions on what's going to happen to reserves. And this bank has, in the last 3 quarters, been releasing reserves. Now, all of a sudden, they went out of their way to tell me they have to build their reserves. So now there's a benign reason for that. It could be loan growth is so phenomenal that they want to, you know, build reserves for the new growth, or there's some underlying credit issues that are emerging. And you know what I would look for is non-performing assets or criticized assets. They've been growing maybe 1 to 3% quarter over quarter at most, you know, for the last 5, 6, 7 quarters. So not a big rate of increase. So, obviously we're all going to watch to see if there's any increase in non-accruals that's more than a low single digit. I have no reason to believe there will be, but the fact that this bank went out of their way to tell me they were going to build reserves kind of has me intrigued.
Yeah.
So let's talk about the flattener for a second. I got time. Everyone knows I love to talk about interest rates. Charlie, since I've known you, you've kind of argued, hey, the bonds aren't gonna do well, just like the squirrel. I got both of you guys excited on the sofas at times because I can maybe sell ice to an Eskimo type of thing. But like here we are.
I bought some more yesterday, by the way.
Now's the time. Actually, let me just give this to everyone as a freebie. Like, now's the time. Like, if you want to, and forget about SOFRs and leverage, the IEF is a 7 to 10 year. You're talking about a 6 to 7 year duration. Like, that's money good. Like, you're at a 4.5, 2 and change real. And if all this stuff we've been talking about falls apart, it's going to work. If Trump loses the midterms, it's going to work. Like, it's just, there's a lot of things that can work for you. And just remember, in 2008, we had a 5.2% CPI, and I don't think anybody was talking about inflation by year end. This time of the year, they were all $147 oil and 5% inflation. Like, things can change fast in 4 or 5 months, basically.
Yeah, I listen. I'm still no fan of duration in any way, shape, or form. But I have nibbled back at the front of the curve yesterday.
So Charlie, we talked about this when you were like, hey, run this through some LLMs. Every bank has a little bit different positioning, right? Which is always funny to me of how we all call commercial bank money, but like it's all claims on different asset pools, which your money at Silicon Valley Bank clearly was not the same as JP Morgan dollars, even though we consider them the same thing, right? Looks like we're at a crossroads, right? So Warsh comes. So walk us through since Warsh comes in, we get that sell off in the front end, and where we are now, and where you're thinking, not forecast, just where you think the vulnerabilities lie, maybe.
Yeah, I think the vulnerabilities lie in the short end going higher. Banks, at least when I talk to them, pre-blackout period, we're starting to worry a little bit about the deposit growth. Now, part of that is because loan growth has been so robust. They've had to go out and borrow money to fund it. And purchase money is more expensive than retail deposits. The average rate paid on an interest-bearing deposit by my banks, the large cap banks, in the first quarter was 2.11%. But there were banks like Wells Fargo that were paying 1.9% on average for their interest-bearing deposits. So if we get some, tightening on the short end, which is my bias, by the way, then I think you're going to see a sucking sound out of the banking system where yield seeking resumes. Yield seeking has not been a source of concern for the banks. But if we get T-bills, trading closer to 4% and banks are paying you less than 2% on your deposits, I think you'll see a remix and money leaving the banking system back into, some other source of yield-seeking vehicle. And so that's a problem, because if we don't get a rise in prime or SOFR, which is what your commercial loans are priced off of, but you get a rise in your deposit costs, NIMs are going to get squeezed, NIMs being net interest margins or your spread. And that's, to me, the big risk for these regional banks. If we were to get an inverted yield curve, which no one is even thinking about, then their swap books are going to get really messed up, as they did in 1994. Because a lot of these regional banks, going back 2 years, were adding on interest rate swaps where they're paying floating and purchasing fixed, on the idea that the Fed was going to be in a rate cutting mode. And so the floating rates would come down and they'd lock in the fixed. And that was to hedge against their natural asset sensitivity. So if we get an inverted yield curve, a lot of those swap books will be way underwater. And that's a risk that, again, no one's talking about, but you have to think about if we, for any reason, we get into a more hawkish type of rate environment.
I'm not sure they can move that much.
They may not.
Because I mean, we've talked about this before. I think he's kind of stuck. I think if we do get a sort of a cut for show in July, that's probably the last one.
A cut.
I mean,
a hike for show. If we do get a hike for show, I think it's the last one.
But all I would say is you got to remember that like the actual like hike. I mean, the rates are the rates. Like we have a hike priced in right now. Like that's in the market, right? Like they have had the intended consequence of putting the cycle ender, which is what I like to call it. You look back at 1929, they did a hike right before things fell apart. In June of 2000, the Maestro did a 50 basis point, like, right around this time, like, boom, that was it. That was the ender. Like the Fed, this they did in the 70s, like that's just what they do. They do the cycle ender. And, they've gotten good at communicating that maybe they don't even have to raise in order to do cycle enders. But around the world, we've seen rate hikes. Indonesia, like there's been a bunch of countries that have had to raise because of the energy thing and all this stuff. So, I mean, I would say central banks have gotten tighter while oil has gotten higher for the last, 4 months, I guess.
Yeah.
So, Charlie, here's the last slide we're going to put on there. We're going to stamp it, tattoo it to the Q2 Benny and the Squirrel 2026 bank earnings. Here's what Charlie's telling you. Oops, sorry.
There we
go.
I like skiing, but that descent is a little bit too steep for me.
And Charlie's a good skier. I've skied with him in Colorado before. Like, you should listen to him. He's like a little Sherpa.
Anyway, yeah, I do think, there's a bear market. And by that, I mean, 20%, down move coming between now and year end. A lot depends on how some, factors play out. In my mind, we're in the art part of the market. It's no longer the scientific part of the market where you can say, well, the earnings are thus, and therefore the stocks will thus. The art part of the market is, you got to look for tells. Maybe it's, Bitcoin breaking 58,000. Maybe it's, the market reacting negatively to a positive Trump comment rather than, reinforcing Trump's comment. And I think that's the part of the market we're in right now. The lag sevens break down below 61. There's certain tells that I've got my eye on. Obviously, credit in the banking system is another one. And
Oracle, right? I as a guy who owns high yield CDS and just constantly pays carry every day, I think Oracle, it's trading in the private markets at 300 plus over SOFR, right? And that, you should have some premium for being in the private market. So you should, but the CDS 160, 170. I mean, if Oracle's basically trading at junk now, there is a chance Oracle goes to junk. And if Oracle goes to junk, that's going to blow up there's going to be a structural lift higher in the high yield market of 50 to 80 basis points that will be the new 300 floor that we have. You know what I mean? Because there's $130 billion and growing amount of debt that will have to be, shuffled to the high yield boys.
Yeah. It's a good point, Ben, because when I was talking with a fixed income manager the other day, he said, there hasn't been a lot of downgrades to junk, and that's the only way you have to sell something is if something new comes into the portfolio and you're essentially indexing. And so you need those downgrades to cause a selling, which causes the spread widening in the indices for high yield.
And
that's such a good point. That is such a good point. That is because it's another point about liquidity not getting tested. Right.
Yeah, exactly. Like when we think about, I was having this conversation with a guy who was on our show at the beginning of last month, this guy Amish, and reality is you have to sell. Like 2022, all the guys who were way over their skis long, all the stuff that worked in 2020, 2021, well, they got tested. And then there was a point where they got, hey, you got to sell. And Melvin Capital's selling down 40%. And the Tiger Global guy is just selling. He's a down 60 year because they're just no moss, no more pain. And so, but when things are going well, no one sells. And so it just floats higher, just like the yen. It's like a little beach ball that like floats. Whereas that's why credit's the better short right here, because if nothing happens or the market kind of goes back, it's not going much lower, right? Like you have to pay the carry, and the carry sucks, but like you're not going to get re-rated the way an equity short could like blow up your ass, like, and like all of a sudden you're down 20% on your equity short, right?
So here's the final tell that I think is just classic. I deal with institutional investors. There's a very large institutional investor that Ben knows very well, that has, numerous receivers of our research. We got some questions about some of our nasty, private credit write-ups from one of these participants. We went back and forth with him for a week, and then he finally just emailed me saying, take me off the list, because he didn't like what we were saying about private credit. And he's fixed income, and I write for, equity guys. But it was clear that he was pissed at what we were writing, which also tells me that whatever he was doing wasn't working.
Everybody's biased, right? Everybody, they want to talk their book. If you talk negative on their book, they're not going to be happy about it, especially if they're paying you subscription fees and you're shitting on their book. Like, that's why sell side doesn't have a lot of sell ratings, right, Squirrel?
Yeah.
Everyone's got incentives. Everyone's got constraints. Listen, guys, let's wrap it up there because I've got to run. Charlie, thank you once again for coming and doing this.
It was a lot of fun, guys.
It was great, and I think there are some real nuggets in here.
Really good. The bank Sherpa calling for the top. Let's hope when you come back for the Q3, we got a 62 KRE, and this stuff has been re-rated down a bit. That would be a nice little feather in your cap, boss.
Thanks, Charlie. That was amazing. Thank you.